Video, we're going to learn how to invest in stocks the easy way. We're going to learn how to pick stocks the easy beginner way, the beginnerest beginner shit. I thought about it long and hard, and I said, how can I break it down to its bare minimum? Like, this is the bare minimum. Anybody else that tells you they got the bare minimum video or book or whatever, they're going to go into all these little details that's going to confuse you. So I just said, how do I condense all this into something that's workable for somebody that I assumed you had no idea anything about stocks. You hear stocks and you run for the hills, right? That's what I assume when I made this video. So just to avoid you calling up a broker or finding a mutual fund manager, both of which are complete assholes and they're just trying to take your money, and they don't know any more than you do, really. But I thought, all right, how can I get people empowered to just invest on their own and pick stocks easily and find a method that is more effective than 99% of what people do? So I boiled it down to like two very simple equations. That's it. They're equations, but it's not like rocket science. It's not like fucking, algebra, which I was bad at. It's like simple math. It's like plus and minus multiplication bullshit like that. So here we have Wells Fargo, right? And I'm going to get into why I chose to look at Wells Fargo. But this is Yahoo Finance. Go to finance.yahoo.com. This is where you're going to be doing all your research and shit on what to pick. And basically, picking stocks is very easy, right? If you're investing, there's a difference between investing and trading. If you see shit like day trading and swing trading and how to trade this and how to trade that, those are more action packed. Those are more like you need to really sit down and invest your time and thanks malware bites. Invest your time and figure out, how stocks are moving, and you have to really look at charts and crunch all these rocket science type numbers, and you got to be an expert. Like, it works and people get rich off that shit. But you got to be a ninja. Like, you got to really be, kung fu, fucking martial arts focused. Like, that's your shit. Like, that's your MMA ring. You're really studying the stock market every single day. It's, most people are not ever going to do that. Most people have shit to do in their daily lives. And that's who this video is for. If you got shit to do, but you would like to put your money somewhere, some type of investment, and you don't like a savings account because it doesn't get you any return, then this is a good video for you, because I'll show you how to invest simply, easily. You'll feel like a genius. You'll be like, oh shit, look what I did. I picked a good stock. And it's not even that hard. It's super easy. So we're going to boil it down to as easy as it can possibly be. And it's really boring. When you see it, you're going to be like, that's boring. But it is. And it's not sexy, and it's not like shit that those brokers and Wall Street specialists and shit can spice up, because if you watch my first video, I told you about how you're surrounded by marketers every single day. There's just marketers everywhere you look, and they're trying to sell you on the idea is this shit is confusing and you can't pick stocks on your own. You need to give me your money so that I can go and invest in these confusing, crazy scientific stocks, for you. I'll take commissions, and they don't know any better than you. And most of the time, it's a self-fulfilling prophecy, because if an expert goes on TV and tells you, I think this stock is going to go up soon. But what people don't realize is what makes a stock's price go up is not necessarily how that company is doing. The company and the stock market, the first lesson I should say, the first lesson is separate the company and the stock market. They're two totally different things. They're two totally different entities that don't have anything to do with each other whatsoever. Very little, if any. The company can be taking a shit. The company can be going down the toilet, but the stock's price is ridiculously high. And it's happened many, 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 many times before. I can prove that. I can sit here all day and prove to you how the company's performance does not correlate to the stock's performance. They're not the two of the same things. The stock market is a bunch of assholes. It's the Wild West, shooting at each other and trying to promote this stock and that stock and, put your money in this and that. And when you put your money in it, that's what makes the stock's price go up. That's it. No other factors. More people buy it, the stock's price will go up. If I get 10,000 views on this video and I tell all 10,000 of you, all right, put your money in a toilet bowl company. That toilet bowl company, by whenever everybody buys the stock, it's going to skyrocket just because I told you to buy it. It's not because the company's any good. The company might not even really exist. I made it up, but you made the stock go up just because of the hype. It's the hype train. But I digress. I went all the way. It's important to know that kind of stuff so that you don't get, sidetracked with all the marketing. Oh, I'm not good enough. I'm going to go with this marketer that tells me to, do this and that. I'm going to give you the confidence you need to do it on your own. And it's not hard at all. I'm telling you, by the end of this video, you're going to be like, that's not even hard. I can do that. It is. It's easy. If you're investing, that's why I said it's a difference. Investing means you're putting your money in, let it sit, be patient. There's going to be ups and downs, but you know that you picked a good stock because I'm showing you the method right here. Separate the company and the stock market. What this method is doing is picking the company. We don't care about the stock market. We're using the stock market as a means to buy a piece of the company, but we're worried about how the company is doing because we're going long term, right? We're sailing the seas upwards. We're going, it's 2019. I'm going to pull my money out in 2040. So I'm picking a good company right now. Company, not the stock market. I don't care how the stock market is predicting this and doing that. Fuck the stock market. It's just a bunch of crooks, right? So here's what we're going to do. I'm going to break down what is a good company to pick. There's an old saying, don't marry a stock. What that basically means is people float around with all these ideas and the hype train. You know what I mean? They say, hey, Snapchat is doing great. It has to be doing great. Everybody's using it. My cousin and my brothers and the Kardashians and everybody's using Snapchat. It's got to be doing good, right? It's got to be the shit. I'm going to buy 5,000 shares of it today and I'm going to be rich. But, that's that hype train mentality. Like, did you do any research at all as to whether or not that company is actually doing any good? How do they actually make money? People using something doesn't mean it makes money. You know what I mean? People were flooding to pets.com back in the day. It was getting millions of visitors a month and it went totally down the toilet faster than you can say pets.com. You know what I mean? Like, it was just fucking gone. But there's the stock market graveyard is fucking filled with those stories. There's something was super hot for a little while and then it was just down the toilet because everyone cared about the hype train and nobody cared about how that company is actually doing in reality. Like, at the end of the day, when you buy a stock, you're buying a piece of that company. It's not, a piece of something, the coolness of it. MySpace, I'm buying 10,000 shares tomorrow. Just because it's cool doesn't mean it's making money. It needs to raw money. Like, I'm going to say this quote a lot on this channel. It's one of my favorites. Men lie, women lie, numbers don't. That's why we're doing let's look at the numbers shit, right? Let's look at the number. What we're doing on this page right here is we're looking at the numbers. We don't care about any other. We don't care what grandma told us to do. We don't care about none of that shit. We care about the numbers and that's it. What are the numbers telling us, right? So we're looking at the numbers and they're going to tell us what to do. We're going to let the numbers be our guide. What are the factors? The factors that we're looking at, I'm going to try to make this video shorter than my last one because it was ridiculously long. But some of the factors we're looking at, we're picking a company. We're picking a company that has a virtual monopoly, right? What is a virtual monopoly? Monopolies are technically illegal, even though some companies I think are like questionable about that. I'm like, how the fuck are they getting away with that? But virtual monopoly, meaning they have some type of foothold. You got to find something, a patent. Sony has a patent on every speaker that's made in the world. It's like, whoa, well, that's some type of, it's not a sure thing. I'm not saying that's true because I don't think it is, but things like that, something that's saying like, all right, this company's probably not going anywhere for a while because they have some competitive advantage that keeps everybody else at bay. That just makes it so that there's like no way that they could do wrong. Like, this company is needed. They're not just wanted. Like, when they're in their space that they're wanted, like a clothing company, like FUBU or something like that. Like, I'm going old school, but like FUBU, like, you know what I mean? They were just wanted. They weren't needed. You didn't need FUBU. They were just hot for a little while. So the next, clothing design fashion company that comes along and does better marketing than them, then FUBU's obsolete. You know what I mean? That's it. That's all you need is better marketing. But some companies, you can't beat them with better marketing. It's going to take a lot more than that. And that's the companies that we're looking for. We're looking for the companies that have such a strong foothold in the industry. Warren Buffett calls them financial moats. That's the companies that he chooses. He wants to find a financial moat, kind of like the castle with the moat around it. You have to swim across with all these alligators and sharks and shit infested in the water, right? So they have a moat surrounding them. So we're looking for that. We're looking for a virtual monopoly. We're looking for a company with mind share. Mind share meaning that they're so ingrained, right, in the minds of the American society, in like a brand like Pepsi. It's a Coca-Cola. It's so ingrained in people's lives. It's so tied to culture that it would just be like, how the hell will we ever see them, see their demise? Like, it just seems like they're going to be with us forever, right? They're not going to go anywhere. They're just part of the culture now. You're looking for that. You're looking for some type of business model that's simple. If you are trying to get into a stock and figure out, all right, well, how do they make money? Like I just said before, Snapchat. If you have to ask, how do they make money? That's probably not a good stock to buy, because if you don't know how they make money, chances are they don't know how they make money either. You know what I mean? All they know is that people use the damn service, and they're trying to figure out how people are going to make money. Like, how are they going to make money? Like, they're trying to figure it out as they go along. They're trying to make money in every type of different way you can think of, and it's make it simple. You know what I mean? Very, very simple. Wrigley's sells gum. That's it. And we're looking for that it can't be overtaken. You can't invent an app to change the way people chew gum. So it's simple, right? And it's probably not going to go anywhere for a while. It's a very simple human function. It's just, you know what I mean? You're not going to make a cell phone that can make bubble gum. You can't, they can't be overtaken. I know it's not sexy and it's not cool, and it's like, yeah, but that's not the cutting edge cool stocks that I want to pick, but it's a sure thing. You know what I mean? That's what you want. You're a beginner, you don't know anything, then you want safety and you want a sure thing. I'm just going to put my money in this. It's safe, it's simple, it's basic, and it's more than likely going to go up for the years to come, and I'm just going to sit back and let it build up. And that's it. You don't have to keep riding all these crazy waves up and down, and maybe even all the way down to where that company goes out of business. Then you're fucked, right? You don't want that. So we're picking the stocks that have that certainty. And I'm going to show you the numbers here that matter the most. So that's what we're looking for. Those four things. I forgot even what I said, but you can rewind it. I think I said virtual monopoly, right? Mind share, a simple business model, and I forgot. Maybe it was only three. I don't know. You tell me. But those things, right? It's a picture you're trying to get. It's a picture in your mind. What is that simple, basic, probably old, that's been around for a while, and they have some type of foothold, some type of inside track that they're pretty much never going to go anywhere. It's like impossible to take them down, right? You're looking for that company, because if you're going to buy a stock and you're going to hold it for a long, long time, then you're willing to take the ebbs and flows. You're willing to take the ups and downs, because ultimately this company is going to always put money in your pocket, right? It's going to go up, because they're just a good company. Nobody's going to take them down. Nobody's going to beat them. So we're looking at Wells Fargo here, and that's the reason that I chose Wells Fargo. They've been around for a long time, right? So, and what I found in the research for Wells Fargo is that they have a virtual monopoly. And the way that their virtual monopoly works is that there's only so many banks that are approved by the U.S. government to borrow money from the Federal Reserve, right? I think there's only like 3 or 4, something like that. But so in order for another bank, a smaller bank, a regional bank, a credit union, anybody else that needs to borrow money, they can't go to the Federal Reserve. They need to get money from somewhere. So they get it from these kind of middlemen type banks, these banks that are approved. And one of them is Wells Fargo. They are approved. They basically take money that the Treasury prints and the Federal Reserve loans out. And then Wells Fargo turns around and they loan it out to other banks. So they're needed. That's what you're looking for. You're looking for need. So how the fuck are they going to go if they go somewhere, if they go, in the dirt and they die and they bankrupt, whatever, they're fucked, right? Then they're also taking down thousands and thousands of other banks with them. So that's probably not. It's probably going to be one of those too big to fail type things. Even if they have some maniac running the company and he runs it into the ground, you know what I mean? They're that needed. So that's what we're going to put our money into: companies that are needed. So here's the numbers that we're looking at. Right? I don't want to make this video too long. I'm already rambling. The main numbers that we're looking at is EPS right here, earnings per share. Right? What this basically means, this is really easy. You know, watch when you see it. Watch. So this is really easy. All this basically means is when you buy a share, just one, when you buy a share of Wells Fargo, you are buying $4.28 worth of earnings. So real actual money, dollars and cents that the company is making profit, right, in their pocket. You are entitled to this much of it with your one share. Because, you know, we own the company. We're the public company. So when you buy a share, this is how much of that company you own, $4.28. So if the stock is going for, I'm not saying, $49.72. The stock is going for $49.72. Let me get my calculator out here. Right? Yeah, I need a calculator. I can't. I'm not a good mathematician, right? So that's probably another reason why this channel's, you know, a good channel for beginners, because I don't know how to crunch numbers and shit. So if I could find simple ways to do it, then you can too. So anyway, we're taking $4.28, right? $4.28, and we're dividing it. All right, we're dividing it by $49.70. It went up. 74 cents. All right, we're going to divide it, $49.74. So this is decimals, right? So this is basically telling us 8.6% if we turn it into a percentage, right? If we pay $49.74 right now at this very second, then we're getting a return of 8.6% for our money, right? We're getting 8.6% return, which is pretty good. You know what I mean? If you put your money into a savings account right now, you're not going to get anywhere near this much. You know what I mean? Think of that as your interest rate. My interest is from day one, from the minute that I picked this stock, I'm entitled to 8.6% of the company's earnings. You know what I mean? So already you're off on a good start, right? Now, what we want to do is we want this number to grow. Because we want this number to grow. Right? If we're buying a piece of the company and we don't care about how the stock is doing, then we're looking how the company is doing, because we know that over time, the stock market it'll bounce around, it'll go up and down, but essentially it'll still flow with how the company's earning. You know, it's think of it kind of like the weather, right? The weather jumps all over the fucking place, but the climate, right? The climate is like the mainstay. It's the thing that is, it's kind of like a dude walking his dog along the beach. You know, the dog's going to fucking jump all over the place. The dog's going to twirl his legs around. It's going to go through his legs, going to go all the way this way and pull him that way. But essentially, the guy walking is the one who's really in control. He really is going to walk his path, and the dog he only can go so far, right? He can only run as far as he can run until the guy pulls the leash back and he's like, hey, come back here. You know, think of that as the company and the stock. You know, the stock is going to move crazy and act like the dog and go wherever the hell it wants to go, but it can only really go so far because the company is doing this, right? So that's what we're trying to do. We're trying to pick a good company because we're going to hold on to it for the long run. We're going to hold on to it 5, 10, 15, 20 years down the line. We care about how the company is doing, not the stock, right? Because we know the stock will follow the company eventually. It's just a matter of time. So that's a pretty good return right there. So in conjunction with that number, we're also looking at this number, PE ratio. And you don't need to know all the way in depth what these numbers mean, right? But it's just good to look at them and you get an idea. PE ratio is price to earnings ratio. It basically means the price of the stock, right? Which is this, $49.69. Now it's just going up as I speak. It's the price of the stock, right? But compared to how much they earn, right? So what this basically is saying is The price of the stock is 11.61 times more than what they earn. That seems like a lot, but actually this is really low. This is a good number. You want low numbers like this. All this number is really telling you is whether or not you're getting a good deal. You know what I mean? So the lower the better. If this number is like 1, that's fucking incredible, right? That's what you want. If this number is like 5,000, you would probably you probably want to stay away from that stock. So this number and this number are two things you want to look at. Now, when we look at this chart, look how crazy these charts are, right? They want to confuse you with how crazy the chart is. So this chart might scare you because it's red. It's in a downtrend today, but it's one day. Like I said today, this is 1D, right? We're going to look at it one day and say, holy cow, I'm scared to invest in that stock, but we're not, because we're looking for the long term. So really, we want to get in at a good price. And this right here tells us we're getting in at a good price. 11.61 is that's a low price. That's compared to the earnings, that's low. That's really good. So then we start moving this chart to 5 days, downtrend, right? Still scaring us. We start moving to a month, right? Somewhat of an uptrend, right? We start moving to 6 months, downtrend. Year to date, a little bit of an uptrend. You see how the stock is just going crazy every fucking time that I move this? But this is what matters right here, right? 1 year, right? 5 years. Now I want you to see the max. I want you to see lifetime. I want you to see how Wells Fargo has done in their entire time on this earth, right? Wham, right? Look at that. This is what we're looking for. Consistency, right? Up, 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 right? Consistency, because we're holding on for a long time. You see, this is 1972, right? It would probably be like a private bank up until somewhere around here or something. But this is what we want. We want consistency. We constant up, because we're going to hold on to this stock forever. We're going to hold on to it for 20, 30 years and retire from it. And if you're in 20, 30-year-old range, you don't mind this anyway, because you're going to hold on to these stocks until you retire, right? 20, 30 more years. So you're looking for these type of stocks that are consistently up. They have ups and downs, but they're consistently some type of financial monopoly, some type of thing that's probably not ever going to go anywhere for a while. And they're consistently, if I ride the storms, they're going to be up by the time I get to the end of this, right? I'll give you an example. I mentioned Snapchat earlier, right? Why is Snapchat bad? Because like I said, it's just technology. Anybody can invent something that can overtake Snapchat. It doesn't have anything proprietary to it, meaning like they invented some patent that's like mind blowing, and it's just somebody else can make some other type of video, social media sharing. So there's Instagram right now. So I mean, you know what I mean? It's So anyway, Snapchat, right? Snap on Snapchat. Here, oh, where'd you go? You're acting crazy. All right, Snap Inc. All right, I assume that's it. I'm pretty sure that's it. And all right, there we go. Come on. I have like the slowest computer on the face of the earth, so you got to bear with me. So as we can see, I probably should have shown you something else before that went away, but I'll show you in a minute. As we can see, look at the earnings per share, right? Negative 97 cents. Negative, right? This is how much money they're earning per your share. Now, would you pay $9.85 to buy negative $97 cents? They're basically telling you, yo, give us $9.85 and we will take 97 cents more. You know what I mean? Like, this is negative. The PE ratio is not applicable because it's under fucking 1. Like, it's not even a 1-to-1 ratio. It's not even the same as what you're paying, right? They're actually taking money from you the minute that you put, but people will buy it. You know how I know people will buy it? Because this is $9.85. Somebody has to be buying it. People are buying it. And this is what I'm telling you. People they follow trends, or they give money to their broker. It's just, if you do this, you're going to be better than 99% of the people that get into the stock market. Just from this basic knowledge. It's just these two numbers. That's it. These two numbers right here. You look here, you say, hey, this number's good. Hey, this number's low and cheap. This is too low because it's not even there. But you look at those two numbers and you say, all right, this looks at, and we can look at Max, right? This is a good example. Look at this. You know what I mean? This is just a complete downtrend. It had a little spark. Probably when it first came out, everyone thought it was going to be the shit. And then as the earnings went down, just like I said with the little parable with the dog and the guy on the beach and all that, eventually the dog is not going to make his own choices. The dog being the stock market. He's not just going to, I'm going to be whatever price I want to be. No, eventually he's going to come back down to earth and be like, look, man, I'm just going to get back to my owner. My owner's going down the beach. I'm going to go down the beach with him. And it did. Look, this is why this is a bad stock. This is an example of a bad stock. Nothing proprietary about it. No financial moat, virtual monopoly, nothing simple. I don't even know how they make money. I can't tell you how they make ads. I don't know. I guess, dependent on people joining their social media and over Facebook and Instagram. It's too much competition. Like there's nothing special about you. And, so that's a bad pick. Anything technology based in Silicon Valley based. I'm not saying don't invest in it, because I'm not an expert or anything like that. But what I'm telling you is, keep it simple. Keep it simple. Pick something really simple, something that's like a foundation, like Wells Fargo is just a bank. There's nothing crazy about it, right? It's just that's it. So we'll go through, and this is what I want to show you on the last one: financials. Just a little extra, a little extra. You can just look at the income statement. And we can see some things like profit margins, right? We can look at how much revenue they make. They make $1.1 billion, right? Last year. And of that 1.1 billion, 381 million was profit. And then out of that $381 million profit, after they paid all their expenses and all the other bullshit, they came out with operating income or loss. They came out with negative $1.2 billion. So they actually lost more money than they made in revenue, but people are still going to buy the stock. This happens all the time. This is you might be shocked watching this video, like, holy shit, how does that happen? It happens all the time. People just don't look at the numbers. They don't know how to look at the numbers. And these same people that are buying this stock, they have a broker or somebody that's telling them, no, it's fine. It'll go back up. It's, invest more money in it. Now's the time to get into it. Now's the time. You know what? It's low. Now's the time to buy more. That's what you need to do. Send me more money. Send me more money. Right? That's what they're doing. So I'll give you some more examples here. What we're going to do is we're going to go to, how about Nike? I like Nike. Nike's a good one. Nike's an example, right? It's not like a virtual monopoly, like they do anything totally different than everybody else. But what they do have is the mind share. They're really good with the mind share, right? We can't imagine a world without Nike at this point, right? Estimated earnings per share. This number's too low for me. That's just me. If I'm paying $85.59, I don't want $1.32 in return. That seems too low for me, right? So look at the price to earnings ratio. It's 64 times higher than what they earn, right? That's not good for me, right? But I wanted to show you this over time, right? Solid company. Look at that. That's their maximum. So it is a solid company, but timing is everything, right? You might not be like day trading or like, trying to be in and out of the market and constantly trading stocks and all that. You might not be doing that, but you still should time when you buy the stock because you want the most return for your money. So right now might not be a good time to get into it. If you want to buy Nike, you would probably wait until this number's higher and this number's lower. You know what I mean? So it is a solid company, but you just don't, you want to get the most bang for your buck. So wait till you get a good deal. And because of that dog parable I said earlier, there will be a good deal. Just be patient. There'll be a good deal. Keep checking the price, every so often, see if some news hit the radio waves that they got sued by somebody or something, because people are panicky. That's what this represents. This stock's price represents people. You know what I mean? People are either buying or selling. They're panicky. You know what I mean? Some shit happens and people will jump off the fucking Titanic, right? And that's when it's time for you to get into the stock because you know that it's a strong company. Just a little bit of bad news isn't really going to take them down overnight. You know what I mean? Warren Buffett said, when other people are fearful, I'm greedy. And when other people are greedy, I'm fearful. And that's something that you should, tattoo on your chest. That's some real shit. if you're going to get into the stock market. But I'm just going to keep this video short, and that's it. You know what I mean? That's pretty much it. You can look at the financials. Just keep it at income statement. You know what I mean? Look at that. They're making $36 billion. Of that $36 billion, about half of it is profit. So that gives you a lot of wiggle room to, even if something fucks up, they face bad news. They got a lot of, I know this is operating income, but this is not a necessity. This other total operating expenses, that could be a bunch of different things. They can cut some things out. This is the numbers that matter right here. They're profit margins. Almost half of the fucking money coming in is profit. So they could always do something with all this. They can fix that. That can be fixed. But so that's it. Down below, I'm gonna have some links. I'm gonna have a link to Robinhood. I'm sure you heard of it by now. It's been out for a little bit, but it's a free stock buying, trading, whatever software out there. And when you start, they give you a free stock. So, and it's free. They don't take any commissions. They don't, it's not a broker or anything. It's just a little fucking screen. You pick stocks. You know what I mean? You put money into it. You can tie it to your bank account and stuff like that. Excuse me. And you can just, buy stocks and watch them grow. And that's it, and just use some of the techniques I found that you found in this video. And it's fucking simple as shit. I couldn't make it any simpler than that. I thought about trying to make it a little bit more detailed, but I said, you know what? I'm just going to keep it simple. I'm going to keep it as simple as possible. These two numbers are the things that matter. Think about your virtual monopoly. Find something in a company that's like, they're not going to go anywhere for a while. It's really simple. And it's, they got patents, and they got such a McDonald's. They got such a strong foothold, and I don't care how many fucking people get into fitness and all that shit. People are always going to want convenient fast food. It's how it is. I want food now. Let's go. And they're even smarter because they get kids when they're young, and they got little clowns and little characters and shit like that. But that's what you're looking for. Something that, and it's so ingrained into American culture. They're not going to go anywhere. There's going to be McDonald's after the apocalypse. It's still going to be here, right? So find a good price to get in. Watch it for a while. Look at those two numbers. And there'll probably be some other links down below the video. I think I'm going to recommend a book. I think it's called Buffettology. You can get that and shit like that. But that's it. All right, guys. Subscribe, like, all that good shit. Take it easy.